Good morning and welcome to this week's edition of BizCheck. My name is Bentro Enjoy sitting in, and welcome today being the 22nd day of January 2026. But I don't know how your 2025 was, but it was a very tight year for many of us, and a lot of Kenyans that did notice that indeed the economy and especially their income and their savings going down. But 2026 heralds a new era where we can change all that. But can we? How is the economy? How are we saving? How are we protecting what we have? That is a discussion that we are having, and today we are moving beyond the financial cliches, and we are asking the hard questions on how to survive this economy without denting your pockets. And where should your money go this year, 2026, and where should it not go? So we are looking at smart money choices for the year 2026. Good morning and welcome. My colleague on the sign language interpretation is Susan Thuku. Of course, we value your input. We are live on all social media platforms, including YouTube and also our KBC digital app. Welcome. And without further ado, allow me to introduce my panelists, beginning from my immediate left, where we have CPA Esther Wamalwa, who is a member of ISPAC. That is, she's also a financial consultant. Karibu sana.
Thank you.
Just next to her, we have Kennedy Monyoncho, who is a director at Enwell Financial Services. Karibuni.
Thank you.
Very quickly, maybe to tell us, let me begin with you, Ken. What exactly you do at Enwell that is touched on the topic of the day?
Well, at Enwealth, I'm a director of the Enwealth Capital Unit Trusts. And unit trusts deal with investments, basically allowing people who don't have too much time to get into the stock market and buy individual stocks. You can actually buy a unit trust. We deal with the money market, whether it's fixed incomes, whether it is dollar income, or whether it is equity income. That's what I'm actually currently running with. Yes.
And you, Madam Wamalo?
Thank you so much. I do so many things, but in relation to the topic of the day, I'm a wealth creation and preservation consultant. This means advise clients in terms of what wealth they can invest in. Yes, you have the investments, but are they creating wealth for you? And once you have it, how do you preserve it for the generations to come? Yes, thank you.
From that brief introduction, from your professional perspective, how would you describe 2026 financial mood? Because 2025 was a little bit technical and tight for many Kenyans.
Thank you very much. Yes, and not only Kenya, globally. And even in the midst of all this global pressure, there are opportunities. There are investment opportunities, both for individuals, for institutional investors, for SMEs who have a medium to long-term view. And just to give a quick recap, in terms of individual, you have, even institutional investors, you must have a financial goal. And then with the financial goal, you match which investment opportunities that you can be able to tap in so that you can be able to meet your financial goal. Yes, it has been challenging, but as challenging as it is, there are opportunities. Thank you.
And I'm looking at, again, I'm looking at 2026, and many people, you know, ushered in the new year with very, very big hopes of a prosperous 2026. But you know very well in January, we always say that it has around 60 days and we are around the 5th day. And many people have counted January being one of the hardest months. And if you begin a hard month, then it's quite hard to pick up the pace. Are you looking at your crystal ball, 2026?
Yes.
Whether the financials, what are Kenyans most keen on? Is it income, debt, taxes, or all of them?
Let me begin by saying that we have made the month 60 or 90 days, as you call it.
Yeah.
Because it is possible that you can plan for your December. I can plan my December the previous year or the beginning of the year, like right now in January. You can actually plan for December because the biggest spend we have is in December. People are going on holidays, people are traveling, and whatever it is that you want to do that time, you can actually plan for it. So if we don't do anything, Jue, this year, and we don't do anything from now, we'll have the same question asked next year in January 2027, how will it look like? Because issues of finance are about discipline, are about decisions you've made, about how you're going to spend your money. And therefore, whereas opportunities will be there in 2026, there are still those who will say, you know, this year is going to be worse than next year. And my previous colleague has mentioned, that actually opportunities exist. But are we willing to look at the what do you call it, where these opportunities are, or are we looking at the difficulties that we will face this year in 2026? When people are making losses, there are many who are making a lot of money. You see that? There is always a cycle. And it's about fear, it's about risk, it's about moving into the opportunities that exist. And that's what makes the difference to anybody who wants to make money in 2026. Yes.
And Esther, picking from where Kenya has left, is that we really need to restructure our budgets, and we have had to do that. In my household, there are some things that I used to buy 5 years ago, but I'm not buying them. Or if you have to buy, you don't buy the big one, you buy the economy ones.
Yes.
And how do we, especially households, restructure budgets when expenses keep rising, especially in diminished income as well?
Yeah, thank you very much. And it all begins with financial planning. You know very well in terms of what are your incomes, what are your revenue streams, what is it that is generating income for you? Is it a salary? Is it you're in business? Is it whatever it is that's generating income? And with it, you have to plan and ensure that your expenditure is either equal to or less than whatever is coming in. That way, you wouldn't have pressures now to go into debt and fund your lifestyle. So it is all about proper financial planning, knowing very well, these are my requirements, this is what I need in a month, and now you go for that. Whatever is critical, whatever you require, and whatever is within your budget, which now corresponds to whatever income that you're getting. Yes.
Could I add something?
Yes. Yes.
There is a financial principle that says you need to live just below your means.
Below your means.
Below
Not
your
within
means.
your means.
No, it's better below, at least a shilling below, so that you have an extra to save, you know, something like that. Okay? Within your means is basically the same as below your means, but we don't want the boundaries to be extended so that you get into debt, as she's saying. Within your means can be a bit fluid, but below your means. Should you want to spend more, then you have to make sure that you earn more. All right? Where you are seeing that your budgets or expenses are increasing, the option you have is to find out, do I have additional skill? Do I have additional assets elsewhere? Where can I be able to make an extra shilling that can be able to address that expense? So it's important that you're able to look at both sides, that I'm not just waiting for the expenses to continue increasing and my salary is at the same place, but I have an opportunity to also expand my income base. Yes.
Yeah, still on the same,
Yes.
how do we ensure that we have financial discipline? Because I believe sometimes that's where we go wrong.
That is can I call it, is $1 million question. How do we have discipline? Discipline is personal. It's personal to be able to do what you must do, when you should do it, whether you feel like doing it or not. That is really a basic definition of discipline. And unless you start, I like what one of my motivational mentors, Jim Rohn, says, if you want to start big, to do something, then you better take baby steps to get where you want to go. For example, you want to say, I would like to start paying myself 10%, all right? I want to pay myself 10% every month. But how does it start? Does it start by 10%? No way. It's not possible. But I can start with 1%. I can start with, then I go to 2%, all right? And then, because sometimes we don't have the discipline, the best you can do is try to automate. Make it automatic so that it becomes part and parcel of what you always do. And once you get used to it, then you are able to live within that level of discipline. Because unless you do it repetitively, you will not start doing it. Yes.
And maybe just to add on that, in as much as discipline is a personal initiative, but you must have plans that guide you. And that's where we talk about a budget. You know, you have to have something that is guiding you. And that way, you will be able now to know, have a picture in terms of, these are my incomes, this is my expenditure. So, and now that's where now the discipline comes in, because now you know exactly what your requirements are and what your sources of income are. And now it is now up to the individual now to be disciplined enough to ensure that that has been executed. Thanks.
And hard times have pushed people to digital loans or mobile credit. Is this a convenience or is it a financial trap?
Back to the discipline we are talking about. Because if you know very well, this is what I'm getting, you have to budget, and that's what I was talking about, equal to or less than. And I've liked what my colleague has said in terms of always budget below what you're aiming at getting. The convenience that come with these mobile loans that you're talking about, it is because you've seen something or you want now to acquire something that is not within your budget, but because there's that convenience of this money that you can acquire, you get it, and most cases, actually, you really don't need that particular item that you're going to get. And if at all you're saying it's the hard times that have pushed people to go, it's usually a cycle, because you will take this month. Come next month, you're already starting from a deficit, and it will be a cycle, not to mention the absurd interest rates that come with it. So it is all about back to the discipline, stick to your budget, and just live below your means.
Ken, I've seen many people now diversifying. You see, you know, I'm working here. I have some warus and some potatoes. Some
Yes.
I'm farming. How can diversification help, and especially when it comes to investing? Because at NWealth you have a wide range of investment plans, but many people are not taking them up.
From where we stand is that, first of all, there's a lot of information gap. People are not able to get information that is practical and that is easy enough to consume. So it becomes a very difficult thing to think about. So when we speak from a financial perspective, our lingo is so complicated. By the time we finish the discussion, people, they had finance, they had money, they had investment, but they don't know then what do they do from there. Now, diversification is important because what it does, it just helps you to manage the risk of the kind of the different assets that you have. Because if you look at what happened 2 years ago, when the bond interest was very high, shares were not doing very well. They were very low. All right? So somebody could have decided, I just want to go into a market where I can get very high interest. All right? But last year, the opposite happened. Okay? Shares did very well, but the bond market interest went, because there is an inverse relationship between the two. But if you're able to get a balance, and especially the balance that tells you, you know what, in good times, this will do well. In bad times, all right, this will do much better. So you are able to ensure that your income is consistent without necessarily having very high ups and very low downs for you to be able to have that balance. So diversification is key. You can have financial assets. You can even have a business that you're running. You can have fixed assets, land and houses and so forth. You can still have those assets in a way that is balanced. But again, that balance continues to shift as you become older, because you want to move away from too many assets, but to cash or very near cash the older you grow, because you want money in cash form. You don't want money that is in 5 buildings and sometimes there's no rent coming here, but you like to have opportunities or assets where I can easily get my money from. So diversification remains key. But again, that is as you start your investment process. And as Esther said here, that it is important to know what are your needs. All right? If I know my needs, I can know how to diversify. I can say I want this in financial assets, I want this in business, or I want this in some kind of fixed assets. Yes.
And Esther, what common mistakes are Kenyans, financial mistakes are Kenyan making, such that you find that January is known as a very hard month for Kenyans?
Yes, and that is back to proper financial management in terms of planning. And if you don't plan well, you will fail. And when the year starts, you know very well this happens in this month, this happens in this month. And naturally, a lot of expenditure happens in December. So as the year starts, as an individual, as a business, why can't you, if we start now from the individual, why can't you plan and know very well, these are my requirements, come December, these are my requirements, and even start saving towards the Christmas festivities, the travels that you'll have, if you'll go on holiday. Start planning. Know initially how much you will require and start saving. Have a fund, as a fund towards it. That way, when it comes to December, even when you're paid, it will just go to your normal monthly expenditure and not now eat into the festivities, so that when you come January, now you're already coming to a deficit. Number two, in terms of things that need to be done, even like school fees and all that, if that you know very well and you know beforehand. So with proper planning, that you can be able to take care of. And yes, there are times that you've planned and the emergencies that happen, unforeseen circumstances. It's normal. There could be a death in the family, there could be illness. And that's why it is normally good to have an emergency fund to cater for such. It might not solve the problem in entirety, but it will not shock you. And it will not like give financial shocks to your budget. And even as we live, you know, we don't know about tomorrow. You can be involved in an accident and you're incapacitated, and you can no longer work. You can no longer do your business. Have you cushioned yourself so that in the event of such, you are well catered for? And that's why we always advocate for passive income. When you talk about passive income and active income is the income that you regularly get from, say, employment. But passive income is where now you're getting this income from investment. Maybe you have your rentals, maybe you invested in government securities, in bonds, treasury bills, or in money market fund. With that, every month you're having some interest income coming in. So in the event of unfortunate happen, maybe a death in the family of the breadwinner, or is incapacitated that can no longer meaningfully work, that flow of cash is still coming in and is able to cushion the family against any financial shortfalls. Thank you.
Ken, I'm looking at Kenya being a middle income country, and a lot of Kenyans are just living with just, you know, there are not many options to save because of the shrinking payslip or the shrinking income. What are some of the investment options for middle income Kenyans at this moment in time?
Great Pandora's box opening and talking about middle income, and talking about even Kenyans not even being there in terms of the middle income. When it comes to investment, Bonanjue, the important thing is to develop some kind of principles when it comes to finances. It doesn't have to check in when you're making a lot of money. For example, because I'm earning middle income economy income, now I can be able to go ahead and invest. Not necessarily. The big thing that we just need to understand that it is the accumulation of the little practices that contribute to huge growth. I'm sure you've heard about if I gave you $1 million today, or I gave you a penny a day doubled every day, which one would you prefer to go for? People prefer to go for
the big one.
Of course, you go for the million. But do you know, if a penny, an American penny, if it doubles every day, you'll make more than $1 million at the end of the year? But nobody wants that.
You want the big
no,
one.
you want the 1 million now.
Yeah.
So that's why I'm saying that the principle should be, irrespective of the economy, irrespective of the income, the practice and the principle should be, I have a good habit of saving the little I have. That is what gives you a break in terms of finances. It is not that I have a higher income, because the higher the income, there's a law called Parkinson's law. The higher the income, the more it grows to catch up with the expenses. So if your expense increases by 10,000, I'm telling you, the income that increased last year will go to eat the expenditure that was increasing, unless you decide on your own that I have a discipline enough that any increase I get, I'm not going to spend. It automatically happens. The more you earn, the more you spend, unless you decide it will not happen for me.
All right, just hold the thought. Let's first of all cross over to the Sarova Stanley, where we are having the Institute of Public Finance releasing a report on the state of the Kenyan economy. The report gives a perspective on the current economic situation and an outlook for the year ahead, 2026. And currently speaking is Dr. Margaret Nyakango, who is the Controller of Budgets. First of all, listening.
To continue to do at the Office of the Controller of Budget, and more so reflecting similar thoughts to those of many in this room. We have a version of that report on our website. If you, on your desk, you can see a QR code. We are trying to reduce our carbon footprint at IPF to support the government in the same. So please see the soft copy. There are a few hard copies, but they won't be sufficient for everyone. This discussion is timely, and we want to give an opportunity to us in the room. We'll take the media interviews later, but if anyone in the room, our partners, our colleagues, our civil society and government actors, has a question or reflection that you'd like to submit, we'd like to open the room for that opportunity.
As I mentioned earlier on, that is just a live feed from the Sarova Stanley, where the Institute of Public Finance are releasing the report on the state of the Kenyan economy. And quite a coincidence that we are also looking at an outlook of 2026, and especially when it comes to matters investment and spending as well. We're getting a little bit more in regards to that a little bit later. But again, I am hosting two very distinguished members who know a thing or two about finance and wealth. And it's a good time to take a pen and a paper to just note some of the things that could change your 2026 financial outlook. Now, we are also looking at some of the smart money decisions that somebody can make, Esther, when we come to 2026, because everyone has something that he or she wants to do in 2026. I want to open this, I want to do ABCD, I want to scale up my farming. What are some of the 3 smart decisions that someone can make, investment decisions, in 2026?
Thank you so much. In terms of the investment decisions for 2026, and we have just seen that the outlook for 2026, though we haven't gotten the figures, yes, yeah. In as much as the conditions, and this we're not just saying about Kenya, it is globally, and the cost of living has really gone up. And with that, definitely with most families, they've really tried to tighten the belts, just to say literally. But that said, which investment opportunities do you have? Because at the end of the day, even as you're doing that small family budget, it's the income side and the expenditure side. If the expenditure keeps on growing and the income is not growing, then it means we'll have a deficit. So you have also now to look at how am I going to increase whatever the income side of my budget. And let's say you are employed, just like normal households and very many people, and you're working on a very tight budget. So some of the things that you can do is agriculture and agribusiness. And we're not talking about look at value addition, so that you're not looking at just raw production, because the budgets are an issue. But you can start from somewhere. And as my colleague had said, even with the little that you have, start from somewhere, save consistently, and you will be able now to get the investment. So we have the issue of agriculture that you can be able to tap into. There's the issue of green economy, where the issue of ESG, where you have that you're looking at being into business that are economically viable, but they are they protect the environment, they are socially inclusive, and they are well governed. So if you look into such like business, that will be wherever will be a plus for you. And there are also so many opportunities when you talk about climate, smart climate. We talk about ESG aligned businesses. We talk about that green economy, because right now the issue is about sustainability for most businesses. And then now when we look at government has offered opportunities where people can invest. We have the short-term and long-term in whatever securities. That's when now we talk about the treasury bills. We talk about now the bonds. With the treasury bills, they're usually short-term, 3 months, 6 months, and a year. And with that, someone can invest in. And how it works is when you're buying, you buy at a discount. And now at maturity, you're paid at par value. So the difference is your return, which is the interest. But if now you can be able now to look, you're looking at the mid-term and long-term, you can invest in bonds. And with the bonds, they give the interest after 6 months. But that is long-term, between 3 to 30 years. There's also the infrastructure bonds. And the beauty about infrastructure bonds is that like their interest is tax-free, so the returns are higher. You can also look at the money markets, and I think my colleague will speak more to it. Money market, where you can just use your phone and you'll be able to invest. Let's say, even right now, let's say you have some money and you want to spend it in over Christmas. You look into wherever money market, and the beauty of money market is you can always access your money as and when for any emergencies that you have, or you're saving towards school fees, or any family projects that you have. Another thing that people can tap into is the issue of, and you talked about the middle class, the growing economy, and with the growing middle class, meaning that they have the capacity and the willingness to spend. So, and there are opportunities in the housing, in the education, in the infrastructure. So you can be able now to look at rentals, and you don't have to look at high-end rentals. Is whatever is within your budget. And in terms of when I started, I talked about an individual having a financial goal, and now matching whatever investment towards your financial goal. So you can do anything within your means, whatever you are able to do. The issue here is discipline, and you have to be consistent, and it's normally long time. You know, you cannot, people should stop this issue of thinking you can always get returns. And that's why most people end up losing money, because now you end up in these quick, rich schemes, and you have not even done your due diligence, you don't know much about it, and you end up being losing a lot of money. So those are some of the things that people can tap in.
Again, let's build from where Esther has left, because looking at Kenya 15, 20 years ago, the money market, the capital markets, everything in terms of financial opportunities was not as robust as it is now.
Correct.
You're hearing about money market, you're hearing of bonds, you're hearing of securities.
Yes.
Looking at 2026, which could be the best avenue for Kenyans to invest? And I'll refer to what you first of all said. There's the issue of information.
Yes.
Even the working class, a lot of them don't even know how money markets work.
That's
they don't
correct.
even know how shares work.
Yes.
Which would be the best avenue, according to you? And which are some of these avenues that you have seen at NWealth, people preferring, especially in January?
All right. Thank you, Bonanjue. I'll just pick it up from where we mentioned. Maybe I just want to add a couple of things that people can, some smart decisions they can do. They can start, first of all, if they can know where the money is going, they will then understand how to stop it from going where they don't want it to go. Okay? That's very important. Because what my colleague has said, they are good investments, but they need money. You know, Kenya has got great opportunities. I mean, we are not food sufficient. That's an opportunity. You can go do that. We don't have enough sugar in this nation. We don't have enough rice. We don't have enough wheat. Those are great opportunities, but they need money. So the essence is, how do I then make this money? Either I go to the bank and borrow some money, or I save it myself so that I can get into business based on the money that I have actually mobilized. All right? So get to know where your money is going and stop it from going there so that you can either accumulate it for you to get into business. All right? Learn to pay yourself fast. For me, that is my greatest principle. Because when you pay yourself fast, you mobilize money faster than waiting to save from a budget which you yourself, you know it's very limited. What that means is when you receive your pay, top line, remove what you pay yourself. Not what you're going to spend going shopping.
Yeah.
What you pay yourself is now what you're going to invest. So assuming you earn 100,000, and I'm saying pay yourself fast, it means before you spend anything else, pay yourself 10,000 every month.
You save 10,000 before even you touch your
Before
salary.
you touch rent, before you touch fuel, transport, pay yourself fast. So a minimum for me is 10%. So if you do 10% per year, Njue, how much will you have at the end of the year?
That's 120,000.
Thank you. Is that good enough for Christmas? Is that good enough to take your kids for a small little holiday without touching December salary? I mean January salary? You can do that very easily. So it's just practice of saying, can I find a way of paying myself fast? And that's why I said, you don't have to start at 10%. You can start at a 1%, 2%, because maybe your budget is constrained, so you can't get there. And then, of course, she's talked about an emergency. It's important you set up an emergency fund. Don't be going to your money in the bank when you have an emergency, or don't liquidate your assets because you have an emergency. Set up an emergency fund that can take you up to 3 or 6 months. Should you have an emergency, you can access it and then you can replenish it. If you do that, then you are good to go in terms of now dealing with money to go and invest. Because many times we are consuming money to go and meet emergencies, whereas if we had an emergency fund, that money can deal with the emergencies to allow you to spend your money on assets that can give you returns. So back to the different avenues that you've mentioned about at NWealth. As I mentioned earlier, I'm basically running the NWealth Capital Unit Trusts schemes. And of course, people, especially the money market, is a new product. We've come from an era of savings account and current account.
Yep.
All right? So, and that's all, many of us know just that. In fact, most people would like to see their money sitting in the savings account so that every time they go and check, they say, my money is still there. And they feel happy about it. But that's a very poor mentality, because money should not be saved in an account. Money should be with other money, making money. Because in life, you want to work very hard and make money so that that money you invest it to make money for you. You don't want to work forever for money.
Yeah, because many people used to, you know, you have like a million shillings, you put in a fixed deposit.
Fixed deposit. Let it sit there. You know, I can, after 3 months, 6 months, and so forth. Now we've got better products which allow you to be able to access the money yet make interest. Like the money market is not a very new product. Traditionally, we've had the capital markets for a long time. I mean, since when it was licensed sometime in 1990s. It was licensed. The Nairobi Stock Exchange came, and therefore it was allowing people to be able to invest in equities, you know. But because people thought the stock market is like pata potea, you know, there's always like
the pyramids.
they were feeling bahati nasibu.
Yeah.
So many people just buy and they wait for it to make money and they take the money out. But they don't understand that investment is long term. You must think, I like what she said, it's a goal. You must have a goal. Why am I investing? It must be either I want to buy a house in 10 years, or I want to set up a school fee structure for my children, or I want to actually invest for retirement. There must be a goal. So if you go to the stock market and just jump in and jump out, then you actually don't have a policy and you don't have a goal, which is very important for you. So money market is a new product which introduces what Einstein says is one of the seven wonders, according to him, quote unquote, is compound interest. All right? Compound interest. Many Kenyans know only simple interest. Simple interest is if I invest 100,000, I will get 10% interest at the end of the year, which is 10,000 shillings. Yeah. Then the following year, I invest my 100,000, I get another 10,000 shillings. Now, compound interest says we will pay you interest on interest. So you have 110,000 at the end of the year. It will invest that 110 to give you interest on interest. That's the power of compounding interest. Because if you invest like 5,000 every month for the next 20 years or so, you'll be shocked that you'll leave the bank with about 1,000,000 shillings. With 5,000 every month for like 10, 15 years, you'll end up with 1,000,000 shillings. So you can imagine the power of compounding interest when it's compared to the normal interest. So when we have the money market, what the money market does is it allows you to actually compound your interest on a monthly basis. You see, savings account is every year.
Yeah.
They'll tell you if you save your money with us, we'll give you 3% at the end of the year. And it's 3% or 4% or 5%. Money market says, you will put your 1 million with us. We will give you 10% at the end of the year, which is about, what, 100,000? Yeah. But what will happen is that this interest will be calculated on a monthly basis. So it's accumulated on a monthly basis. So would you, if you would like that interest to be added to your principal, we will add it so that we pay you interest on month 2. And then on month 3, they'll pay you interest on interest of month 1 and 2. They'll add it to what you've already invested.
This is better return.
Which is, of course, a better return.
Yep.
Or the option is you can withdraw your interest. So you leave the principal there. Don't touch the principal. You see how flexible that is?
Yeah.
And which is a very good product, I think, for anybody who has some money and they're saying, look here, I have a monthly expenditure of, let's say, 30,000, and all I need is 30,000 every month, and I have some 1 million shillings somewhere or 2 million. I just put it in the money market, and every month, I'm able to withdraw. So that, for us, is one of the good products. I like the equity product because I'm more risky myself. I take a bit more risk. Because equity can give you a much higher return. The end of 2024, let me surprise you, equities brought home 35%. Now,
5%.
Yes.
Even fixed deposit, we are fixed deposit with the best we are doing is 7 to 10%.
Even bonds were giving 18%. That's what I'm telling you. You should be able to
let your money work for you.
Let your money work for you. Take a bit of risk. I know all of us are scared of risk, but risk can be a good thing. Okay? So if you had your money in equities, 2024 end, the return was over 30%. And therefore, you also need to know now what is happening. Where can I or when can I invest in stocks? So we have the equity side. You can buy units in the equity side. You can buy money market in terms of units also. We've got the fixed income. So what we do, we buy the bonds and the treasury bills for you. So you buy like units so that there's what you call, you use the collective the collection of very many people who have bought. So there is what you call economies of scale, and therefore you're able to negotiate a better rate, and people are able to get a better return. But again, it depends on what you're looking at, because fixed income has got their disadvantages. All these products have got plus and minus. I mean, fixed income, if you are coming for fixed income, you have 1 million shillings and you're waiting every 6 months, because fixed income comes every 6 months based on what we get from the central bank. It means you won't get as frequently as you want, and yet it is not inflation adjusted. It means if I have 1 million shillings today and I'm getting 10% for the next 10 years, that 1 million, the value of that 1 million in 10 years will not be 1 million. Yep. And therefore, it is not a good product if you're looking for that kind of return of income. The better product to look at is equities, because equities grows with inflation adjustment. So you don't lose any money and you don't lose your value. So any of these items, anybody can join. I mean, the joining amounts are very low. It's very affordable.
How much are we talking about, just for example, for our viewers?
Money market is just 100 bob.
100 bob?
Open your account, send 100 bob, and you start from there. But don't expect to make 1,000 in 1 year. I know people put some money and they imagine it is going to make a huge impact. But you can open an account. But why put 100? Just put in whatever you have that you can invest to get a good return on your money.
Yeah, and let me pick from where Ken has mentioned that you really don't need to put, if you have 1 million shillings, a fixed deposit. That is the old-fashioned way of doing things. But there are so many people who are old-fashioned to the point that they would rather put their money in a fixed deposit account or invest in real estate.
Yes.
Let's take a look at real estate. Is it quite as it is, or maybe 10 years ago, 15 years ago, far much better than it is now? Or would you still advise somebody to invest in real estate?
Real estate is interesting because now, one, the initial outlay of cash that is required definitely is high. And it will depend on so many factors in terms of where is it located. If it's in an urban area, then chances of you being able to recoup and making even money out of it is higher than, let's say, maybe in the rural areas. So the location maybe is also very, very key. And also, depending, you need to also to do a market survey in terms of the requirements of the region. You know, that the requirements, what is it that people require? What is it that has high returns? What is it that is marketable? You know, these things keep on changing, because I remember there's a time when now everyone was doing the hostels for accommodation, and they ended up tying in a lot of money in there. And even recouping what was put in there was not possible, because students would want to spend as little money as they could, and with that, so many people ended up losing. So it's about being strategic. It also depends on the location. On the location, and also just do a very comprehensive survey in terms of what are the requirements and what is more competitive, and what does the market require, what is the gap in whatever region that you're doing. So you can still make it with the real estate, but you have to take all those factors in place.
And Ken, I've seen people also invest their pension and into some of the products that you guys have. Is it risky, and would you advise somebody to also think about that?
Pension is very important. Pension, I wouldn't advise anybody pension to go in to spend your pension in real estate when you're retiring. But you want your pension to pay you for the rest of your life. All right? You can access lump sum, and most people get lump sum. There is a statutory minimum that you cannot get until you are, I think the age now is 60. Above 60, you can get it tax-free. But if you retire at 50, 55, there is a statutory amount that you cannot withdraw. So you leave it there, and they'll invest for you. But once you get the lump sum, you can actually, we have products that you can use. There's a product called income drawdown. What happens, we'll take your pension, we'll invest it. It will be making interest. All right? So what happens is that we can agree how long do you want to draw down your pension. You can tell us 10 years. Actually, the maximum is about 10 years. All right? And then, so the money is invested, and every month, depending on your liquidity needs, you are able to draw down your income. Or you can just buy a pension that gives you a flat figure and tells you we'll give you this until you retire. Our advice is that when you are with your pension, ensure that any asset investment allows you to be able to get cash flow on a monthly basis. Any investments you're thinking about, it should give you cash flow, because cash flow is what keeps you alive when you have retired. If there's no cash flow, my friend, you die much faster than you had expected. So if you have a pension, don't start building a house if you've never built one. I think that's very late, late in life. Just find a way where you can either a money market is a safe place to put it in, or a bond is a good place to put it in. I know there are bonds in the market that are up to 30 years. So you can decide for the next 20 years, I can put my bond. I've got my lump sum, which is 20 million shillings. Lump sum in the bond giving me 20%, which is 2 million per year. 2 million per year is approximately 50,000 per month. Hey, 150,000 per month for the next 20 years? Why not? All right? Yeah. So don't think about fixed asset. Don't look at illiquid assets when you have your pension. The time to think about assets is when you are still employed, or when you're running a business actively. That's the time to think about assets. And you are generating assets that are going to give you passive income that Astap talked about when you have retired. But don't think about that when you have retired. When you have retired, just manage your pension.
I'm also looking at, Esther, how financial records, how important they are. Even for the smallest and the tiniest of business. I'm saying this because I've seen a boda guy, he's a former University of Nairobi student. For the past 2 years, whatever he makes, he writes it down. You know, he showed me a book and I was amazed. Each and every day, he writes down everything and every expenditure. If it's service, if it's brakes, if it's tires, if it's any, he puts them down. And tells me that gives him a financial outlook to see exactly what exactly am I making? Should I go to work today? You know, how much money have I made today? How important are financial records for everyone who is making something, especially for the small scale traders?
Yeah, that's very good. And the issue, you cannot overemphasize the issue of financial management. You can be able to manage, you can be able to plan when you have the records, when you have the figures, when you have something to refer to. So with the financial records, it's usually very important, because now you will be able to know, how are you spending? Are you spending, are you overspending? Are you spending within your budget? You know, you can be able, it even shows a trend. How is your expenditure? So you'll be able now even to tame or track, or even now be able now to change if needs be. Same as income. You can now be able to tell and do your forecast in terms of which are the good months. You can imagine now these people in the informal sector, they can be able now to plan well, because they have the records, and they can be able to see that actually in December I make more income, and now plan accordingly. Even as government institutions, we are able to know how governments are doing well, or they are faring on in terms of the records that are there, in terms of what is their net worth, what is the GDP, for example, of Kenya, what is the GDP of the US. So with that, maybe the economies are able now to compare. So if, as an individual, you don't even, you know, that should be your first step in terms of what is even your net worth. What is it that you own? What is it that you owe? And then with that, you are able now to plan accordingly. So, and it can be as simple as, you know, just taking a book. You don't have to be in any accounting class. You just take a book and record, these are my daily expenditures. At the end of the week or at the end of the month, you will be able to see how you're faring on. This is what I've been able to make. Now, at the end of the week or at the end of the month, you can be able now to see. And now with that, you are able now to plan accordingly. Thanks.
Ken, we are looking at financial, you know, red flags.
Yes.
If you remember the pyramid schemes,
Yes.
they were here for a while before Kenyans really knew this is a red flag.
Yes.
Which are some of these loopholes to avoid when you're investing in 2026? And I will refer to what you said in the beginning, where there's lack of information for so many products, and you will find somebody investing something, and then after a few months is like, you know, this is not working for me, because he wanted maybe 100 to make 1,000 shillings.
Yes. I think let's begin by saying, let's be wary of greed, because if you are not greedy, you can most probably make good choices. Sometimes it's important to remove emotions from investments, because when you're investing, it's a very laborious, very slow process, and people don't like slow processes. Everybody wants everything quick. For example, if I tell you, like I've just talked about paying yourself first, and I tell you, you know what, pole pole paka mwisho wa mwaka. So somebody starts thinking, hey, every month, why can't I just do it in 1 month? It's not possible in 1 month. So what people need to be very careful about is that investment, it can be very slow, but it's very rewarding. I think it is the reward that you should look at more than the pain of putting that money aside. What kind of reward do I get at the end of this investment? Now, one of the things we need to you talked about red flags, all right? Red flags. You know, when there's greed, what likely happens, you go for any opportunity that you see is giving you a lot of income. And one of those was the pyramid schemes. And there are many of them, by the way, even now, but they're very quiet. You never get to know until you go online and you're trying to invest, and they tell you if you put in, you'll get 0.5% per day. And you're very excited. 0.5% per day doesn't look much, but of course, in a week, it's nearly 4%. And you're saying, whoa, 4% even within a month, that's good return. But all those are generally pyramid schemes. So avoid where you're seeing very high returns. Don't be too quick to move in. Because we have some products that have been registered and licensed by the capital markets that give very high returns. But those are specialized products that you also need to understand how they operate. And you need to be able to take risk that is equivalent to those returns, so that you don't end up, at the end of the day, don't lose because you didn't get to understand. Now, secondly, please, I know it's like it may not sound like a red flag, but don't invest in something you don't understand. It is not going to help you sending a shoemaker to buy you precious stones, because a shoemaker doesn't understand how precious stones look like. Neither do you want to go just invest in shares, because, and you don't know what they are. Yeah. Invest in yourself. Understand what they are first. If you are unable to invest in yourself, look for a professional who can help you, somebody who can give you a bit of knowledge that can help you enhance in terms of the investment. For me, those are the two key ones for now as 2026 begins. Don't go for very high interest, watch out, all right, in those areas. And then, of course, don't invest in what you don't know. Understand what you're investing in.
Very well, we are looking at smart choices for the year 2026 here on BizCheck, and we are taking a quick break, but when we come back, we will also be wrapping up on this, and especially if you want this year to be, you know, a far much better year than 2025 and the other previous year, and how to set your financial goals for 2026. Let's take a quick break. We'll be right back. Welcome back to BizCheck. We're on the tail end of this conversation. We are looking at smart money choices for the year 2026. And we have Kennedy Monyoncho, who is the Director in Wealth Financial Services in charge of Capital Unit Trust. And we have CPA Esther Wamalo, who is a member of East Park. Ladies and gentlemen, we are on the tail end of this conversation. For which are some of the red flags to avoid when it comes to saving, Esther, and which are some of the smart money decisions that somebody should take in 2026?
Thank you so much. In terms of saving, ensure you have all the information. Get this information. It is your right. And you can seek professional advice as well, so that you have equipped yourself with information before you take your money and save in whatever scheme that it is. You ensure you have all the information, and as we've emphasized, be patient, start where you are, be patient, the returns will come, but it takes a bit of time. So be patient and don't think that you'll just get the returns, the high returns that you're thinking about, which you can, anybody who wants to take advantage of will tell you, only just to rip off all the money that you have. So be patient, get all the information that you have. Another thing, there's no right time to save. So don't say, don't wait until you make enough money. There's nothing like enough money. As my colleague had said, even if your salary, even if the returns from your business were tripled today, so will be your lifestyle. So start where you are, consistently save, consistently and just be patient, knowing very well that, you know, if you do that, it becomes part of you, part of it. It's a habit that you've formed, and in the long run, you'll be able to reap.
Ken, how can low-income earners genuinely invest? Because at the end of the day, if you're talking about you have nothing at the end of the month, then it becomes very difficult to invest. Or the take-home is a little bit, you know, on the lower end. How can low-income earners, or what are some of the options for them?
It's not about low-income earners, Joe. It's the principle. It's the principle. You see, if I'm earning 10,000 and I'm willing to set aside 50 bob every month, what is the principle or the habit? Saving. Okay?
Yeah.
So it doesn't matter how much you are earning. The issue, the habit that we must develop is, can I save out of the little that I am making? Because truth be told, Njue, you cannot earn 10,000 for 10 years. Year 2, you'll earn 15. Year 3, 16. Year 5, 20. Year 10, you'll be earning maybe 50,000. If you had the principle and the habit of investing little by little, you will be investing even much higher amounts when you earn more money. Now, you see, shares are very cheap. The stock market allows us to buy 100 shares, lowest, okay, or 3,000 shillings, whichever is lower. Whichever is lower. Either you buy 100 shares or 3,000 bob. Now, 3,000 bob even if you take a whole year to save 3,000 bob, you can buy shares. But the issue is we think of today and we think of what I have is so little is not sufficient to do any investment. That is a big mistake. If the habit of putting aside little by little, even the low-income earners, who I don't want to call low-income earners, even the income earners can be able to withdraw some money and be able to invest it. It is basically the habit, all right? And if I'm investing 3,000, don't expect 30,000 in 1 year. If I invest 3 million, don't expect 10 million in 2 years, because it is directly proportional to the amount that you've invested and the interest that exists. The investment follows some criteria, lay down principles of doubling your money or bringing money home. So let's not discriminate. So long as you have a form of an income, you can invest. The stock market has made it possible that you can buy. I mean, today you can go buy shares for 300 bob. Do you know you can go with 300 bob today and buy shares?
300 shillings?
Yes.
Many Kenyans don't know.
Average is 1.4 shillings. Average is 1.4 bob. So if I have 1.4 and I'm buying 100 shares, it's 143 shillings. What are you talking about, man? That's the information we are saying doesn't exist. But it is there in the newspapers. You can go and say, this share is 2 bob. 2 bob. This is 5 shillings. Now, KPC is 9 bob, eh? All right? Historical says it will go up, maybe to 11, 12, then it will come down. All right? Some of us would prefer for it to come down first, then we buy.
You buy.
Yes, because that's how you make money. That's how you make, not speculation, that's how you make money. All right? So there is opportunity. I think it's just information and the willingness to take that risk and say, let me put it here and wait for 5 years and see what happens. Yeah.
And when it comes to investment, Esther, and we want to, we even have some hustles, you find you have something else that is, bringing in some income. How do we measure whether an investment is truly working? Because you find sometimes somebody has maybe a shop, but before he or she realizes that it's not making anything and closes down, it has even eaten up the capital that you started or you began with. How do we measure whether something is doing well, the health of any investment that we make this year?
Back to the records. If you have proper records, you'll be able to, you will have indicators and you will point how are you doing financially in that business venture. So you've recorded your expenditures, you've recorded your income, and you can be able to see the trajectory and the trends. And back to the emphasis on having proper records, and depending with the size of your business or individual, if you're not able to do it, and that's where now where you seek professional advice. At ISPAC, we have qualified accountants who are able now to do for you your books and all that. But it's all about ensuring that you have proper records for you now to be able to gauge how you're doing. So definitely, when you're making losses, you can be able to see from the records that you have. So that will act as a guide to show you how you're doing. Yeah.
And Ken,
yeah.
I'm looking at financial stress that a number of Kenyans are mentioning that the economy isn't working very well, and they're hopeful that 2026 is going to bring some good tidings. And, just like you said, you should just live below your means. This is easier said than done.
I agree.
And the financial discipline that we are talking about here,
yes,
it's very easy to talk about it, but very hard to implement. Because you have to do away with a lot of things.
Why I speak like that is because I've come through that process. It's not an easy process. Even doing a budget, how many Kenyans have a budget? Budget is very simple. A budget doesn't need money. It needs your will. Okay, let me now do a budget this month. Even me, right now, I'm revising my monthly budget. I just want to see where my money generally goes. It's not an easy thing. Me, who is an expert, it's not an easy thing. How about somebody who I'm trying to advise? That please, sit down, find out where your money is going. It is a very difficult thing, and it needs your willingness to say, I am serious about this thing. If that will is not there, it doesn't matter. 2026 can give us good returns. GDP can increase, but you will not benefit because you never took the will to sit down and say, my life must change. all right? Back to that discipline. My life must change. You can't live on inertia and expect returns in your life. You must have a reason, you must have a plan, you must know a why I am doing what I'm doing for me to be able to invest in what I want to invest. Until that happens, I have no problem singing until I retire myself from singing, not from life, from singing. But let one or two people listen and say, by the way, he's saying sense, but until I take action, it doesn't matter, it's just information. Yeah.
Ladies and gentlemen, my director informs me you're out of time, so I'm going to give you each a minute for your closing statement, and especially when it comes to advising Kenyans who are watching us on how basically to look forward to 2026 and avoid the every time January hangovers, financial hangovers. Esther?
Back to the final thing is we just have to go back to financial management. We have to go back to financial management. It is not easy, but it's doable. You have to critically look at yourself, analyze your situation, because it's individual based, and take that bold step and ensure that your finances are in order. Even with the gloomy economy, you can be able to invest, and you start where you are with what you have. It is the discipline, and you ensure the mindset that you have, you're in it for the long run. As Warren Buffett says, if you don't make money work for you when you're asleep, you will work for the rest of your life. So let us purpose to ensure that we have money working for us even as we sleep. Thank you.
Ken?
I would like to repeat, financial goals are going to be critical for your success in 2026. Even clearing your debt is a financial goal. Setting up an emergency fund is an emergency goal. I mean, is a financial goal. Learning to pay yourself first is a financial goal. Just tell yourself, this year, I have to do one of these. And once you do that, for me, I need to be challenged that who has paid himself first for the rest of the year and they spent January money in December. Thank you.
Very, very well said. In uncertain times, smart money is not about how much money you're making or you're earning, but how well you plan, protect, and grow what you have. The choices that you make in 2026, I'm talking about financial choices, may determine your financial freedom for years to come. That's why we put a cap on this very practical and very interesting conversation on smart choices, smart money choices for the year 2026, and the professionals here have really put it into context. I've been speaking to CPA Esther Wamalwa, who is a member of ISPAC and also a financial services expert, and just next to her we have Kennedy Monyoncho, who is Director Enwell Financial Services in charge of Capital Unit Trust. Thank you so much, ladies and gentlemen, for your insight. I'm looking forward for this conversation again, and let's see. Maybe we can take stock after a couple of months. We take stock.
We come and see where
Yeah.
people reached. You don't remember what you said.
Yeah, we really need to check that and see our pockets whether 2026 can offer better tidings. On the second hour, we'll be looking at matters milk production, and I will be having Michelle Arum from the Hughes, Kenya. We'll be talking about understanding how feeding, how enhancing production, even through quality feeds for better milk production. On the second hour, let's take a look.